is more important than my traffic, Gemini. Welcome back, y'all.
Hey, yo, Dbloc. Oh, you probably stepped away.
Nervous, some people.
It's all about you.
All right, well, I guess I gotta give that a second. So yeah, just real quick, let's run back. Where my head's at. Basically on our third push on the 15-minute. Rise 1, rise 2, rise 3, and we've come up high enough for this to count as an M pattern if it breaks. And so what I'd be looking from that point is a move down to the 200, rise 1 back to the 50, move down to the 50 MA, rise 1 back probably to like the 200, and a final move down to golden pocket, where we would then W pattern and go get CME somewhere going into Wednesday afternoon. If I could have it my way. That's what I'm looking for right there. And then that would end up giving us a larger W pattern that, in my opinion, has a decent chance of failing like its full measured move. This is where things are going to get sketchy. Because this is when the bulls are going to be like, well, right, that would give us a new a new local ATH anyways. And then that would bring people that are still playing this bull flag out from their deep, dark, depressing holes that they're in right now. Still valid, right? All of this is still valid. But the world is also about to frickin' implode, so there's that. I know for a lot of you stoners out there, you think today is just 420 and is happy, or Doge Day, obviously, right? It's also a thing. Today is also the day where the last pre-war tanker makes it to its dock. So the last gallon of oil to leave the Strait of Hormuz before the war, right, at old prices, that tanker reaches its destination today. Right? They say that these things move across the water about bicycle speed. Right? So far, people haven't really started to feel the crunch because all of those tankers that left, a month ago have been coming in steadily. Today is the day where the last tanker comes in and you look out across the ocean and there's nothing else on the way. I'm putting together, I did a deep dive last night and this morning But I'm putting all the info together because it's a lot. But I do want to present it today, because some of the spookier shit that I've been talking about could very well be on the horizon. Specifically, these energy lockdowns. So remember where you heard it first, when you start to see the rationing and the airport lockdowns and the highway lockdowns. Not necessarily in the US. It's going to be felt in Asia first. Yeah, slowly but surely, Mick. Slowly but surely. None of this shit is anything to freak out about, though. This has been the base case, right, that we've been talking about this entire time. Should be excited that at least you see it on the horizon and there's a plan there, and you're not going to be just acting impulsively, right, or being reactive to news when it drops. Well, they were, the low prices, right? So like now you're gonna start to see that delay in deliveries, right? It's not just that oil's gotten more expensive; it's that there's literally less tankers coming through the strait, right? So till now, everybody was getting regular deliveries, right? Because those deliveries started before the war. Now's when you start to see that stall in deliveries start to take effect, right, across the world. Yeah, now's when you're gonna start to feel the supply shortage. Now, to be fair, these assholes have been charging us for way more for the oil, and that's the old oil. Like, they didn't even get the expensive oil yet, and we're already paying $5, $6 a gallon. So you know how that is. Like, they definitely didn't wait for the last tanker to get there. But some decisions need to be made because, well, I'm going to wait till I pull the full report out, though, but the price of a real gallon of oil, I mean, a real barrel of oil, is not the same way that we talk about silver, right? When we used to look at the silver chart and we used to be like, nowhere on the planet can you buy an ounce of silver for $70, right? Nowhere on the planet can you buy a barrel of oil at $90. Nowhere. This is the closest idea we have, and I need to find the dated Brent. This is the dated Brent Mini, right? What this means is these are barrels of oil that are being sold that are meant for delivery within the next week or two. Yeah, these are paper. This is your paper. These are your futures. This is the actual price of oil. Right? Actual price of oil was at 134 just recently. It's now taking a dip, but it's still at 114. Right? So what that means is these guys are selling futures contracts. I will sell you a contract right now for a barrel of oil later. Right? You can hold the contract, because I mean, unless you have somewhere to store the oil, right? You don't have anywhere to store your oil. All right, cool. Let's sell you paper. You can take delivery on the oil whenever you want, right? It's supposed to be a deliverable. Well, not whenever you want, at the end of the contract, right? In about 2 weeks, they're going to have to start delivering on these contracts, which means that they have to provide a barrel of oil. They're not going to be able to buy it at 90, right? They have to buy it at 115. If it was to happen right now, they'd have to buy it at 115, which means that they're taking an L, right? But they're trying as hard as they can to drop that barrel price with all the manipulation that we're getting. This shit here is just insane. Like, this shit here is just ceasefire on, ceasefire off, ceasefire on, ceasefire off. So when we look at this chart, when we look at the paper chart, and you're wondering, people are like, why? Why would they put themselves in that risk, right? Well, when you look at the paper chart and you look at how we have it set up, right? If price comes down, that's peace. That means there's peace in the strait. If price pops up, that means there's war. Right? Well, it sure makes you feel a lot better about buying the stock market if they're telling you that the price of oil is chilling. You know how oil can't live over 100 that we say because everything goes to shit? People start freaking out and they don't invest, and then stock market starts going down, da da da. Well, if they can make you think that the price of oil is under 100, right, then they can make the stock market do that. Right? They can make NQ do that at a time when it should be dropping. Well, that's the same thing that we're talking about. Go. The U.S. Mint is over. Have you ever been somewhere and, all right, first talking about silver. India already put out a message that their mint, the Indian mint, like the government mint, will not be delivering the silver that people bought. They told them they can keep the paper and they can get their silver eventually, but they're not getting delivery. Just straight up, we don't have it. Australia shut down the sale of their mint. We shut down our sale and then we repriced at the don't want to sell it price. That's what 190 is. 190 is if you want it, you can, but right. So what they're basically saying is we don't have it. We don't have it. We don't have it. We can't tell you we don't have it because then there's a supply shock and then we're screwed. But if we charge you $1.90, then chances are you won't buy it anyways, and we won't have to prove we don't have it. Yeah, it's the don't want to sell it price. Like when you go see a guy about a car and he's like, I want $45,000. Like, bro, it's a 97 Honda Civic. Just tell me you don't want to sell it. It's like Costco. Went to Costco the other day and there's a limit on the amount of silver that you can buy. This is a company whose model is to sell by bulk. And they're telling you that you can't have as much as you want. That says something. Right? If they had it at the escalated prices that we're at now comparatively, if that paper price is the true paper price and they had it, they should be looking to sell you every ton that they can get their hands on, right? Oil is a little more sneaky because silver you can take physical, right? You don't have to play with paper. You can hold silver. You can hold silver. You can put it in your safe. You can stack it. You can whatever. Not everybody has the faculties to self custody oil. Like, what are you gonna do? You know, stack up a couple barrels in the backyard. You know what I mean? Like, so that's why they're able to manipulate paper the way they are because most people can't take deliverables. Bro, the real commodities traders, I'm talking OG gangster commodities traders, they will rent a tanker and send it through the strait, bro. They will rent the tanker, send it through the strait, get their oil, pay to store it. Yeah. There's people who do not play. It is gangster. You know you're gonna need first, you know you have to pay the Iranians. Right? So you've already got to deal with that. You're gonna have to stop and deal with them. Then you're gonna need some military on board to deal with piracy and shit. Then you got to worry about the Americans stopping you on the way out. I'm just trying to make this trade. You know, like damn. Can I just make this trade? Exactly. Pay them their 2 mil and then still get shot at. You guys heard the that audio from that Indian tanker, that captain? He's like, we paid you the $2 million. We're currently under fire. I'd be tight. Exactly. They're like, nah, that 2 million was for us. You got to deal with the Houthis on your own. They're gonna want another 500,000. I told you guys about 2 years ago that like everybody that I spoke to that had a bag, like a bag, like not trying to get the bag, but the bag's already there. Their main focus for the last 2 years has been deliverables, investing in deliverables. If I can't receive delivery on the investment in physical, I don't want it. When you notice that rich people stop trusting the promises of other rich people, that's important to pay attention to. That whole, come on, Bob, you know we're good for it. That shit is a wrap. Anybody else having issues with Gemini today? Yo, that shit we did yesterday was cool. If you weren't here yesterday, we go catch the last stream. We pulled up an old stream and we used that Gemini integration in YouTube now to like sort of dig through it. But the stream that we picked happened to be a good one. Like we were talking about the top of the market. We still hadn't hit top. We were a couple months away from the top. We were talking about predictions. I went through a whole sort of spiel like I did the other night about have we bottomed yet? But I went through a whole sort of layout of if we had topped, when the top was coming. Killed it, if I do say so myself. But the Gemini tool is cool. Because what you can do now is you can go back and you can pick any old stream. You can pick any old stream and you can, well, look, I'll show you. Check this out. Because I know that the main issue we have is that we have these long 12-hour streams, right? So it's like, you know, to sit and watch the whole thing, and then there's a bunch of hours of nobody talking. But hold on, let me see. If you go to this stream here, that one doesn't have it yet. Hold on, let's go to the channel. Lives. So like here, perfect example, like the Are We There Yet that we did the other day, right? Although you can go all the way to the beginning and go to like the last But if you go there, does this one have it? This one doesn't have it. But this one did have it though. Let me just pick a random one. Of course, this is gonna do this now. Let's go look at the one that we saw yesterday, I guess. Dun, 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 dun. Alright, am I tripping? Am I doing something wrong here? Or... is there a way to go from last to first, first to last on this? There we go, oldest. Alright. Oh shit, look at the old thumbnail. Alright, so you see... First of all, where was Bitcoin? That's the main thing I want to see here. 64K. Damn. Round trip, huh? So if you go to ask, right? Oh look, we got chat and everything. So you click that star and then it pops Gemini up on the side. And then you can click summarize video. Dives into indicators. Hosts discuss various projects. Dbloc shares his approach to trading, emphasizing the importance of staying disciplined, managing risk, and ignoring the fluff. All right, and then there's more questions sort of down here. And it's like all the shit we talk about. Like for some reason, what did Cat Williams predict about 2024? We must have just been in here chopping it up, talking shit. Interesting though. Let's see what happened today though. Guessing we rejected back down to the range. Wait for confirmation. Yeah, but it's just a little interesting tool on YouTube. I didn't. When did Jamal? When did it drop? Because I didn't notice it until yesterday. I don't even know how long it's been there. Okay, cool. Well, it makes my job a lot easier because remember the other day I was saying like if I could have my dream, it would be to have every single 12-hour video categorized and searchable to where you can pull up a certain day that you were talking about a certain thing and find the timestamp, right? So we're like halfway there. If I can find the video, now I can get the timestamps inside of that video, right? But what I really want is to be able to go to YouTube, go to my channel, click Gemini, and say, show me every video where we talk about the price of silver, or where we mention metal super cycle, or we, you know what I mean? And then it's great because then if I want to make a certain clip, I can just do that. But if I just want to look at the information, like not necessarily make a clip. We're in the future, but only if you want to be. And unfortunately, to a certain degree, only if you can afford it. That's something I never considered when I was younger, right? Like when you're young and you think about the future, you're like flying cars, jetpacks, robots, all of that type of shit, right? But when you're a kid, you just assume that everybody gets it at the same time. Like there's just gonna be a line in the sand where we go from the past to the future, and now everybody's living like the Jetsons. Yeah, there should be one in there for Leviathan. Most of the indicator sections in there just have my default. I mean, not my default, but have my loadout basically. But it's weird because we're living in a time right now where we're both in the future and in the past. Right? Like I would say about 60% of my house is automated. Right? I had a robot lawnmower before they stole it. Right? I'm using AI, almost every day to do things. I would say I'm pretty far up on the scale of like close to the future. Right? I'm not fully like EV, and there's certain things I could be doing that could be higher on tech. But my next door neighbor is cutting the grass with a push mower that has no engine. Right? They're still listening to radio shows. Like it's weird. It's like you can almost choose to live in the past or the future right now. Like just the other day when the workers were here and I had to leave the house, go to the ATM to take out money to give them cash because they didn't have Cash App, they didn't have PayPal, they didn't have crypto, they didn't have, you know what I mean? It just depends on who you're around, bro, honestly. Like, and probably having kids around helps too, because your kids will put you on to new shit. All right, so smaller time frame where M pattern drop one, drop two. Larger time frame where M pattern drop one. All right, so this is the smaller M at the top of that rise 3, rise 1 back into the, I mean drop 1, retrace back into the 50. Looking for our drop 2 now. Where did my squiggles go? Hold on. Well, that's one of them, but I was looking for my squiggle. That squiggle's too neat. Where are my messy squiggles? Nah, forget it. I give up. This will have to do for now. Excuse me. Don't forget to hit that like button, y'all. 120 people in here and only 25 likes. YouTube needs to be reminded every once in a while that this content is worth sharing. Did it pop you, Chris? You guys are crazy, bro. Yeah, no, I hear you. A lottery ticket, you know? I told y'all the other day, like, that was a horrible drop, and it probably is never going to recover. But that doesn't mean that there won't be a 2 to 3x dead cat bounce or something that comes out of that shit. It's just a dangerous game to play because that's exactly what it is. Def, but do you know why? Has to do with that Clarity Act. Right? When your mom and your aunt are using stables to buy shit off of Amazon and Shopify because it's quicker, or not even because it's quicker, when they're using money to buy something and then behind the scenes that's getting transferred into stables and the transaction is finishing off in stables because it's quicker, and they don't even know they're using stables at all, right? That's gonna send all dominance popping, tether dominance, USDC dominance. Right now, the dominance that we're used to on stables is how many stables are in the crypto market. Right now, erase the crypto market and then put in the home market, the car market, the Uber Eats market, the food, the clothes market, all, you know, commerce in general. But that's a two-edged sword because now we can't look at USDT dominance going up and automatically think that it means something for crypto, because there's other things affecting that dominance now that weren't affecting it before. So we're gonna have to figure out what the rhythm of that is, right? Exactly what percentage of stables are being used for commerce, and then we can subtract that from our total dominance and try to come up with a crypto stable dominance. But it's gonna be difficult. Yeah, I agree with that, H. That's exactly what these bounces do, is they give people a chance that got caught out. Dump. There's a couple of guys that I never want on my case. CoffeeZilla and Zach XBT. It's not that he's that good, it's that he's passionate. You don't ever want somebody making it their life mission to destroy you. You know what I mean? Like, he is going to dig until he finds something if you get on his, you know. And Zach XBT for other reasons. Um, he's managed, you know, people are to the point where he's, when he says something, people just assume it's true, right? Because he's been part of catching so many of these dudes. So just having him investigating you is like you might as well, you know, in public opinion, you're already screwed. I remember I watched that video live when he first dropped that video. He almost cried in that video, bro. He was so frustrated. He was like, "Well, good luck out there, y'all." I tried. Shit, where's my phone? All right, my bad. Yeah, what's up? On what? You hear noise in the background. There's crazy people. Ignore them. What happened? What are y'all talking about? Am I missing something? When I say there's crazy people, that just means compared to like normal people. I'm always the craziest person in my house. Always gonna be alright. They need help. Mm. Nah, that's my people. Come on, Market Maker, you're gonna give me that drop all the way down. It isn't even really about getting deeper into this position that I wanted to drop for. I'm really just rooting on the timing. I'm actually hoping that my trade takes longer to play out. Because what I don't want to do is close this CME, excuse me, and still have 2 days of up ahead of us. I don't know about y'all, but I'm tired of waiting, man. I'm ready to get the next leg of this shit going. The sooner we drop the hammer, the sooner we start to actually be able to really make long-term buys, you know? Being normal takes too much effort. That's the trick. That's the lie that nobody ever tells. That the secret nobody ever exposes. Thing about raves, they get you high and then you get addicted and then you want to keep going back. They did a really good job bringing a genuine rave experience to this coin. All we need now is for the SEC to step in, and then the cops showed up. And then it would be like perfect. But dead cat bounces, man. Just mean reversion on the hourly, right? Even if this is dead, just mean reversion on the hourly. For it to just then. The thing is, when things drop this hard, that little move back up to the 50 is a freaking 4.5x. Not saying it's gonna happen, but what I'm saying is that natural mean reversion can be pretty explosive when you lose 95% in a coin overnight. But it's really just defensive rescue plays that move this. Think of the logic. Let's say you fell for the, like, remember when we were looking at this uptrend here? This one specifically. Right, we were talking about how unnatural that was. Right, not following any real patterns of how things move, just basically being held afloat. Anybody who bought in there was buying between 110 and 130. Right, so let's say their average is right around there. And then they woke up down here. Right, so this isn't the type of underwater that you sit and wait to come back from, right? Like, this is one thing, oh, it'll come back. It's another thing to think that you're gonna get 12x to get back to where you came from. So the only way to rescue yourself out of this sort of position is to add to the bottoms, right? Or to take the L. But if you bought at $20 and now you're underneath $1, you can buy with size, right? So what happens is you buy 10 times the amount of coin that you have up here for less than what that cost you. And it brings your average down, right? Depending on how hard you go. So the goal here for big money that got caught is going to be to bring price back up to their new average that they just dialed down into. The problem for you guys that are trading is that you have no idea how high or where that line is. Like, you have you don't know if they went so heavy that they only have to get to right here to break even the $2, right? Or you don't know if it's up here. But trust me, when you get to that point, it's going to collapse again. So just be very careful playing this up. And try not to get too greedy. Just think, if you lost 90%, you'd be happy to get even 50% of your money back. You know what I mean? So there is aggression here, but in my opinion, it's defensive, and they're trying to dump the rest of their bags at a higher level. Yeah, I mean OM, MYX, right? There's been like at least 10 or yeah, about 10 of them of this type of coin since the top of the bear market. I'm banned from Coinbase, brother. I would check for you. Nah, this move on the way down, these are vectors because of the sheer speed. So remember what vector candles are. Vector candles measure tick volume, right? Tick volume is how much, how often does price change within a candle, right? So even if the reason that you can have small vectors, right? And you can have large candles that aren't vectors is because in those large candles, price might do that, right? Inside of that candle on a smaller time frame. On vectors, price will do this. Right? It's being suppressed on both sides. And that tick volume is just going, right? Now, what also changes or what also makes a vector very quickly is if price just flushes. Right? If price flushes quick through the vector, and in those flushes, there's people trying to buy and getting ripped, buy and getting ripped, buy and getting ripped, buy and getting ripped. Right? So in these cases, it's not market maker setting long positions that gives you twice the volume. It's people freaking out and the aggressive speed of the drop that does it. And that's, if this was just a 50% drop or a 30% drop, then I'd be like, yes, right? But this is this complete flush. Right? Like this thing literally just, and the crazy thing is it can still go further. Like this thing dropped 97%. Right? So, in my opinion, market maker's move here had more to do with paying himself on these shorts that he's been setting this entire time while everybody's been having a ball. Oh, you guys still want a long rave? Got you. Got you. Got you. No problem. No problem. This entire move was a massive payday for market maker. And no money. Right? Like, he didn't have to add to the dump. All he had to do was clear the books. Remember, market maker chooses. There's two choices the market maker can make. Market maker can decide to give you the money that you need for your trade. Let's say he wants price to go up, right? He wants price to go up. The order book is full of orders. Market maker can either match trades that have enough liquidity to eat those orders if he wants price to get up, right? Or he can remove his orders from the order book and let a small trade have the same effect. So it's the same to the bottom. That price didn't have to drop 90% if market maker didn't want it to, right? But the refusal to match those orders and the clearing of the book on the way down is what just, and it's not like the market, like if a team rug pulls, right? Market maker, just like everybody else, has to make a decision if they're trying to match those trades or not. If you see the team coming in and dropping a bunch of coins on market, you're not going to absorb that. You're going to get out of the way, right? There's bad news coming. You clear the books. It's the same thing that we saw happen on 1010. There was one market maker responsible for what happened on 1010, right? Wintermute on Binance. But then why did the price slip on every other exchange then? Right? Well, it slipped on every other exchange because market makers knew if they didn't remove orders from the book, they were going to have to take that L. They're not in this shit to lose. Right? So they removed their orders from the book, and when the panic selling started, you saw it across all exchanges. The true mechanics for why it happened is that Wintermute runs a separate book. So this is pricing for spot, right? Inside of here, you have all your market makers, right? Controlling their own little environments, right? And there's not much overlap, right? But there's just enough overlap where they try not to step on each other's toes, right? So this is basically spot world. Like we learned about market makers yesterday, by law, they have to quote the NBBO, right? The national best bid offer. They don't get to make their own prices. They've got to quote the NBBO, right? And then if any time price makes it outside of these controls, right, where you get a difference in price from one exchange to another, then arbitrage bots come in and they fix it, right? All of these market makers run arbitrage bots. So if it ever gets away, their bots come in, right, and actually fix the price, settle the price. So inside of this is also futures, right? For the most part, 99% of the market makers that control the spot book control the futures book, and they all use the same book for futures. So if there's any discrepancy on futures, then the bots come in, right, and they bring everything back to where it should be. Price settles. The problem is that Binance, while their market maker was in here, right, their market maker is one of these guys on spot, they had a separate book for futures. That was out here. The problem is that it's expensive to pay market makers, right? So the top 4 exchanges have their own futures books. But the smaller exchanges don't. They don't pay for it. They go with the big dog. Right? So inside of this futures book for Binance, you have, what is wrong with you, Dbloc? You have your Maxis, your WeXs, your South Korean exchanges, your Most of the ones that let you trade leverage, that don't ask for KYC, right? All of these guys go off of this price, right? Now the problem is that Binance collateralizes its price. Some central exchanges too. Some centralized exchanges. It's not just DEXs, but most perp DEXs, right, go off of Binance's order book. Now the problem is that there was a discrepancy in the book. 3 weeks before this happened, Binance came out and made a announcement that they were going to go to a main market maker model, right? So basically they were going to bring their futures market maker and everybody else into the fold, right? Because they found some vulnerabilities with the 3 stable coins that they were using to collateralize, right? Basically, people were taking advantage of the difference between the spread, since it wasn't being, since the arbitrage bots weren't coming across, right? These arbitrage bots that are here to settle weren't coming across, right? So whales were taking advantage of the arbitrage between the futures book on one exchange and the other. The problem is that these idiots announced it and said that they were going to fix it, but the fix wasn't coming for 3 weeks. So what that basically did was put a big bat signal up for whales to come do as much damage as they possibly could before that arbitrage closed. Now, when the whales came in and started dumping, right, to try to take advantage of the arbitrage, the stables that they were using, the USD1 and all of that bullshit that they use on started to depeg. When those stables depegged, all of these exchanges that use this book got automatically margin called, right? Automatic deleveraging. As they started to deleverage, it started to affect the main book, right? As market makers started to look over and see the cascade that was happening that was about to affect them, because this type of thing isn't stationary, right? They had to remove all their books, right? So market makers came in and they cleared their books. So now you have people over here getting wrecked, looking to hedge their positions, hedge their losses on other exchanges, and you've got empty order books on all the exchanges. And then the auto deleveraging started cascading, right? One exchange after another, after another, after another. Stop losses skipped, buy orders skipped, add margin skipped. I think that they went too hard. Nobody wanted what happened to happen the way that it happened, right? But they were trying to exploit something, and you had like 4 different things happen at the same time that had to happen in the order that they happened for what played out to play out, right? Had that happen, and then remember what set the whole thing off, right? Right at the point where the whales were putting pressure on Binance, market makers moved all the market makers cleared all the books to protect themselves, right? Because they're delta neutral. Trump came out and dropped tariffs on the world for like the 3rd time. Now, most of us didn't react to that tariff news because it's like, okay, it's just, the problem is that the people that did reacted into an empty order book. So, you know what I mean? The reaction was way more. If you look at Bitcoin only dropped 19% on that day. What it showed me, honestly, is that at that time in the market, there was absolutely zero market for altcoins. Zero market for. The only thing holding altcoins up in October were market makers standing orders on the books. That's literally the only thing holding it. And we know that because the second those orders were removed, alt collapsed. But it was a little bit of everything, right? Without the whales trying to take advantage of the exploit, Binance wouldn't have been under the pressure it was. Without that Binance book being under the pressure it was, their stable wouldn't have depegged. Without their stable depegging, then they wouldn't have the auto deleveraging event on Binance. Without the auto deleveraging event on Binance, exchange market makers don't clear the book. If exchange market makers don't clear the book, then when Trump announced tariffs and people freak out, there's not an empty book. We would have been able to absorb it, and it would have been a non-event. You know, that's why I say that all of these things had to happen in order for it to go down the way it did. And only two things in the world could have saved you from that day. And this is why I'm so annoying when it comes to talking about leverage. Only two things in the world could have saved you. One, don't trade leverage. You would have lost 19% on your Bitcoin. You would have lost on your alts, but if you held them, they all recovered pretty nicely, and you would have left with maybe 20% across the board loss on 1010. Maybe, right? Or if you do trade leverage, make sure it's only 5% of your total portfolio. In that case, you would have lost 19% on your Bitcoin. You would have lost 5% of your total portfolio, but it wouldn't have been the end of the world. The problem with Sui, and tell me if I'm wrong, but the way people really got wrecked is that they panic sold into the dip, and then the recovery was so fast that they weren't able to buy back underneath where they sold. That was the real nasty part of that whole thing. That everything recovered while exchanges still weren't letting people really buy. For the most part, people were still having issues. Yeah. We just got to remember that at the end of the day, these exchanges and these market makers, they're businesses. And when shit hits the fan, they're going to protect themselves before they protect us. I want to find that day. I want to go and I wasn't dating the lives at that time. So it'll take some time to find that episode. But I want to find that day. I remember being abnormally calm through that whole thing. Like, and what I mean by like abnormally calm was like I had to put an effort to stay calm. It wasn't my natural talent to like be chill needed like active effort to like, okay, breathe, chill out, take those feels you're feeling, put them in a box. There's work to be done. You want to know what the most amazing part of that was, though? At least for me and for us, you know, in the chat. Well, that's not, that shouldn't be there. That should be on the 9th. Hold on. There we go. If you were here beforehand, and I love this Google AI shit. Now I feel like, I can talk my shit because I can go back to the video and have and have Gemini pull it up. We were watching M2 for months and months and months, and I said, I mean, if I'm lying, somebody stop me. It had to be at least 6 months out that my de-risk was October 9th. Right? That's when M2 was taking its big drop. Now, we did have expectations that we could possibly make it higher, right? This wasn't like I was TPing because I thought, oh, this is the very top. I just knew there was going to be a major correction at that point, which is usually how it happens, right? You take profit on something that you should take profit on, and then it ends up rolling into something bigger, and then you look like a genius because, you know, whatever. But this was the final TP here, right? Because as we came down, the chances of putting in that W and putting in new all-time highs or whatever. So these two were when we left, right? Or when I left. And, you know, whoever in the group was playing along. On the 9th, major de-risk. Everything but Bitcoin was taken out at that point. On the 10th, everything lost like 95%. And then I finally got rid of the Bitcoin once it looked like we were double topping and we were going to roll over.
Whoever the whales were that whatever started that, it was smart that they picked the day of the 10th, being that they knew that there was all the cycle bros were going to be taking money out. So they already figured
Yeah.
there would be a downward push on the market, so they could just accelerate it.
When people tell me that the bear market, that there's no bear market because institutions don't care about the bear market and they're going to run this shit and da-da-da, really? Because that's not what that tells me. What that tells me is that they respected the hell out of the market, gave each other several days to get out at the top, and then started, you know, helped start what naturally should have happened, you know, anyways. But I think there was an overreaction there because we were talking, like how we were talking about the vulnerabilities that Binance. I don't think this was ever the intention. I think this was like, oh shit, what did we just do? You know? But
If we go back to just before that, there was a guy in chat, and he was like, "Yep, threw my short. That's it. We're going into the bear market." And he was getting so much heat from everybody. Like, I didn't even like hearing it. You know, just like, you know, whatever. But
just
I remember
timing, bro.
him saying it. Yeah, and like whatever. This is my first bull market to be trading, but I just remember hearing it, and like there was no way in my mind, you know. I held my peg too long, obviously, but I just remember him being like, "No, dude, this is the time," and him being like so like frank about it and confident. And I just remember like the feedback from everybody in chat was, you know, was amazing. So,
There's too much
and
emotions. The people are too hype at the top, bro. You can't. I'm a very unpopular person at the tops and the bottoms. And that's just because the amount of emotion that there is. Like, people don't want to hear that shit, you know? Like the other day when we pulled up we were all the way at the top, and I pulled the fractal again from 2022, and somebody in the chat was like, "Oh my god, another fractal, bro! This guy and his freaking fractals." It's like, bro, it's not magic, bro. I'm not making it happen. Like, don't get mad at me, right? I'm just pointing out that cloud looks like a penguin, and every time there's a penguin cloud in the sky, we get shitted on. That's all. Take it for what it's worth. But I mean, I was very unpopular here, right? when we were coming down into this bull flag, when everybody, including me, by the way, because we had 3 targets: bear target, base target, and bull target, right? My heart was set on the base target. 150 was like probably the price point that came out of my mouth the most often when I talked about where I thought we were going. And we were sitting in a pattern that would have got us there, right? You know how unpopular I was right here when I was saying we're gonna major de-risk on the 9th? Like, what do you mean? Like, why? You know what I mean? Like, and I mean, I don't want to speak for anybody else, but those of you that were here, and it's cool because I do the same shit too. But when you heard me say the 9th, you know, I know there was plenty of people who thought, I don't know. Like, literally at the same time where I was talking about getting into silver when everybody was waiting for alt season. Right? Like, there were people that were literally like, why are you talking about precious metals when we're at the edge of alt season? And then I'd have to go and explain the rotation and the, you know, but it doesn't make, nobody really wants to hear it at the time. And it's understandable. It's just human nature.
Are you saying
Some
on the
person.
9th you knew it was going to do what it did on the 10th?
No, not at all. On the 9th, the reason that we got out was because of M2. We got a gift on our freaking lap because of what happened on the 10th. I didn't get out on the 9th because I thought this was the top of the cycle. Like I said, I was still looking for the base, even though we had hit the bear mark of the bear level target, right? Remember, there was still tons of volume, there was volatility, there was good news, there was every reason in the world to think that it can continue going up. What saved me was following M2 and saying, okay, I'm okay with getting out and then buying the retest of this flag, right? Or buying the retest of support, which we did, and then riding it up. But the problem is we didn't ride it up, we double topped. At this point is when I knew. At this point here, I was like, there's a good chance that that's it. You know what I mean?
Yeah, and I think you were turning off Discord so you could like spend time with chat trying to get them through it. I remember that.
Yeah, it was the sentiment was crazy at this time, bro. It was like really, really, really bad. But again, we had our levels. We, just literally played it. We played the extension. I played the M2 going down, and then the volume came in on that drop. Right, we came all the way down, hit support, had a volume, and that was more than enough reason to get in. We ended up putting in higher lows. Right, we played that all the way up, but that double top, that stopping volume candle. Right, it's the rules that keep us safe. Now, it just happened to play out that you went into your mean version and you broke and you went, cool, right? But you don't have to know it's the top, right? All you had to know was that liquidity was retracing, and we had been following that for months and months and months and months. So if you were here at that time, you were already, and what a topping candle looks like, right? The fact that you had a stopping volume candle right on a double top, bullish engulfing. Then it starts to come down and you start to go, you're like, okay, good TPs. Now, I fought against my own timing, right? I outthought myself, and it cost me $3,000 or $4,000 off the top. The reason I say that is because, and Zusi was here too. Does anybody remember when we were down here? I was playing this up, and I was about to take profit. I was thinking about taking profit. I was like, I don't know, I think this is over. And Zusi was like, you're trading against your own TA right now. And that's because a while ago I had given him that top terminal date. Like, we knew when the top terminal date was going to be. But even me, right, that I'm comfortable with how the cycle works. I don't ignore data that's in front of me, you know. And at the time, there was enough volume to make this go. There really was. We could have done it. 1000% think that we could have still popped up, created this W. We already fractaled into a bigger W, so we had the smaller W, right? Then you're fractaling into this W. So my TP here, right, was with the idea of, it's crazy how you can remember shit like this and you can't remember like people's birthdays and shit. My idea was TP, if price comes down and holds, right, that 382, and we start to put in that W, then we go heavy here. Right, we go heavy here for that move that takes us up. That would be the measured move, which would then build that W out, or sorry, which would then take that top out, right, which lets you know that this is a breakout and not a deviation. And then the next step would have been the base. But that didn't happen. You know? If I was playing this strictly by time, which just have, you know, as much as I respect the cycle, I understand that every cycle is different, right? Every monetary policy is different. So I'm never going to just blindly ape. Like, I think the bottom is going to be on the 5th and the 6th, right? I'm not going to save every dollar I have and just YOLO the entire bag on the 5th because I think that's going to happen, right? I'm still playing the momentum. I'm still, you know, it's just the ability to pivot and not think yourself out of your sort of original ideas is a good idea. But I think we did a lot better than most groups who, that same feeling we were having here that it could take out the highs, right? They were being sold that dream down here. And those same groups are being sold that dream still to this day right here.
Dude, I went to it was like a team party thing, and our corporate VP was there,
Ugh.
and he found out that I trade crypto. I don't know how. Because we have these chat channels at work where we can just talk about non-work related stuff.
Oh, okay.
And I was trying to help some people that were like, "Hey, is this a good time to buy or whatever?" And I told them about your channel, and I told them about like, um, it's not what you think. It's not like a, and he knew your channel, man.
Oh shit, really?
Yeah, and
Oh, that's
he
cool.
was like, yeah, he was like, he wasn't criticizing you because he knows you're a trader,
Mm-hmm.
but from an investor, he was like, I don't know why you guys are playing around up here. We just wrote it from 15 to 125, and I go, well, man, it's a trading channel. It's not. I mean, I guess you can give investment guidelines or whatever for yourself or whatever, but I go, they're there to trade each day, you know, the ups and downs or whatever. But he's like, man, do you? He goes, because I that seems like a lot of effort. And I go, well, I go, you sound like you bought the dip and or you bought the bear market and got out when you were comfortable, but it's really not the same. And so I kind of guided him into the whole purpose of the channel or whatever. But I didn't ever drop your link in any work chat, so he found it on his own.
That's cool, man. That's good to know. But yeah, he's right. I mean, he just sounds like a surfer, and there's nothing wrong with that, right? There's people who are going to be very happy just working their day-to-day lives, making good money at the jobs that they're making, and investing their money and making it actually do backflips with having to, you know, little to no effort. But once you get the taste of what you can do compounding, it's kind of hard. You know what I mean?
Yep. I mean,
So
obviously,
it's all about
some
not
people.
getting to the bottom. I guess the easy answer is it's about getting to the bottom with more money than you sold at the top.
Yeah. And I guess if you have other options, other money revenue generating options in your life, whatever those are, then I could see how it's like sitting down at a computer and doing this is not, not the best use of his time, but
Of
because he has
course.
other mechanisms, right? But some of
Mm-hmm.
us don't have those mechanisms. So we're forced to learn surgically and get better at something like this. You have to pick your poison. Oh, it's poison, but you have to pick your thing you're going to do your 10,000 hours in, right?
Yeah. This that you're learning on the 5 minute is gonna make the daily and the weekly seem like child's play because it's exactly the same thing. There's no difference. Like literally exactly the same thing.
Hello, Puff here. Dbloc, I just wanted to let you know I'm learning so much from your classes. It's making a lot more things click. We appreciate you.
I'm glad, bro. Good. I'm good to hear that from somebody who's been here for a while because I know you've heard me talk about all this shit over and over, but having it in
Yeah,
one place.
and that's what it was. Like I I understand the terminology a lot, so it's like now that it's like more of in an in a structured place. Yeah,
Yeah.
everything is starting to click. I'm like, okay, okay. I was understanding it before, but it was just certain key elements that
No, I get it.
I knew I was missing, but you're just filling in the elements that I
Yeah.
need. And good looking, my guy.
Anytime, bro. But like looking at this weekly chart, right? Like after staring at the 5 minute for as long as we stare at it, what does this look like? And forget it's a weekly chart. Pretend it's a 5 minute chart. Well, you had your support resistance flip right here, right? Price came down, held, rejecting off of that. We would expect that if that rejection holds, that 50 EMA would come down, right? Eventually get a touch, and we'd be looking for one more wave down. Right? You've got your M pattern, drop one, drop two. And then you'd look to see, okay, well, where's support? Right? If we are going to get one more drop down, well, this is a large area of support here. Right? So if you mark out the bottoms, you'd have 52K, 48K. If you start to sprinkle in some of the tools that we have,
The hell is a shoe bag? Is that new terminology I missed?
you throw on your smooth moving average, put it on the 230 period. I don't know. Maybe I'm tripping, but it doesn't seem that complicated when you back up. My homeboy just had a kid, and I'm talking to him the other day, and he goes, "What the fructose?" I was like, "What?" Like he says fructose instead of fuck
French
now.
toast. So D, where do you think we're gonna be by the end of the year?
Like what, December?
Yeah, December.
A couple months into our buys at the bottoms, still hearing people
Yeah.
tell us that it's going down. There's going to be a mixture of people saying that this is a dead cat bounce, don't fall for it. And then the other half of the people are going to be saying, do you think it'll ever go back down to 48?
Right. You know, and I think there's something else we don't. I think there's something else that we're forgetting about the downtrend. We're definitely forgetting about what the WTF moment. You know what I mean?
Not me. I'm looking forward to that. That's
Oh,
already
oh
planned
no,
out.
I'm definitely looking forward to it, but it's just weird because I haven't heard anybody like bring that up. We always get that WTF moment. You know what I mean? We always get that.
Excuse me. Bro, not only am I expecting it, but I've already got the insert news story box waiting for it. And my best bet as to what it's going to be.
Yeah. You're saying 48? I'm thinking the prediction was like 38. I mean, I'm gonna be buying in the 40s, so
No, it's the same. You know, we don't just pull static predictions here. What we do is my bear market or my most bullish target is 50. That's our bull target, our bull case. My base case has always been 44 to 48. And then my bear case is 38.
okay. Couple more months and we'll see what's going on.
Yeah, we'll see, bro. We'll see.
I'm
I'm in
starting to feel
position
like
to be spectacularly wrong in 4K, but I like my odds.
but I think you like it though. You know, you like living life on the wild side.
I like my odds, man. I like my odds. I'm cool with betting on me every time.
So I'm starting to think I'm more of a surfer. That's what I'm thinking.
Yeah, nothing wrong with that
Yeah.
at all. Look at what an amazing surf trade this was here, bro. You
Oh
would have
yeah.
got
Oh
in
man.
at 25 and you would have been chilling, bro.
Zeus, I like, man, Zeusy was dropping the jewels on the low. If you was paying attention, I was like, oh man, but you know, I can't front. I kind of sat out this one, and I sat out last year too because I'm like, yo, there's something that I'm missing. But now I realize what it is. I'm more of a surfer, but I could watch the charts day to day. But I I I think surfing is more for me.
There's nothing wrong with that, bro. Some of the best trades. Literally, like the best trades. The problem is that it's so time sensitive, right? Like if
Right.
you're not here when that wave hits, you know? And
Yeah.
that's what I tell people. Like, it's very tempting. Even people right now that are like, I'm going to focus on spot. At the very least, the bottom of the next bear, I'm just going to buy Bitcoin. I'm going to focus on spot. I'll tell you what's going to happen. We're going to come down to the bottom and everything is going to be popping. And no matter what the hell you take a leverage trade on, it's going to print. And you're going to get seduced by the money and you're gonna end up trading, and you're gonna, by the time you realize you haven't bought any spot, you're gonna be halfway through the bear market or the bull market. So catching that wave is what a large majority of the rest of the Cypher school is going to be dedicated to, right? Is making sure that you're in these people who caught at the very least the bottom 10%. And if this seems too boring to you, which I understand, right? Because me personally, we can do better than that, right? There's 1, 2 obvious spots. Like, not, you don't have to be a TA genius, right? 2 obvious spots where you could have taken profit and bought back more Bitcoin, right? And compounded so that you didn't just buy 1 Bitcoin at the bottom and end up with 1 Bitcoin at the top. Right? Where you bought 1 Bitcoin at the bottom and ended up with 1.7 at the top, right? Or 2 at the top. Think about the math about that. Think about the math of that. I know 4 years seems like a long time. I promise you, this shit feels like it was a year ago. Yeah, coin margin is also very useful, but you've gotta know what you're doing, because you can lose coin as well as you can gain it. But yeah, I like coin margin. So like I said, if this looks just too boring, then there's no reason why you can't just come to the 3-day. You bought once, you sold once. You bought again, sold again, right? A little bit of distractions here, but for the most part, you got in before it went. You sold, you bought. At this point, what was it? 649, 108. Give me a second. Sold 93, you bought 73, then you sold. Yeah, so give or take, close to 2 Bitcoin is what you would have ended up with at the top, right? Now, for argument's sake, let's call it 2. Let's say you turn 1 Bitcoin for 15K into 2 Bitcoin that you only spent 15K on. And then you sold it, let's just say above 20? And let's say you sold it when we sold it. Let's say you got out at 120. When price came down here and hit 60, what did you turn that into? You sold at 120, and you now had 2 Bitcoin. And then you waited 6 months, and you just put the entire bag back in at 60. Right? You just turned 1 Bitcoin into 4 Bitcoin in 4 years, less than 4 years. Not waiting for the bottom, or anything. Like, we're not even at the bottom. You could have bought your 4 Bitcoin and just sit here and go on vacation, screw it. But
probably
if you
still made money.
Yeah, but if you didn't and you bought it closer to 40, right? This isn't what bottoms look like.
Definitely not.
This is what a bull market looks like. A bear market looks like. M pattern, bear flag, bullish channel that takes months. Or hella multi-month long consolidation and a rip. Forget that we're looking at this time frame. Like I'm telling you, pretend this is the 5-minute chart. Would you be ready to go all in yet?
No, I would maybe throw 10% in as a speculation, but that's not really surfing.
At the very least, I would want to see what I've been saying that we want to see this whole time, which is, one, price needs to get back over that bull market support before anything. Two, I need to know that enough time has gone by. Guys, look at, I hate to keep throwing them under the bus, but look at ES. Better question. Do you think that Bitcoin can pump sustainably against legacy? When, not if. When legacy finally starts what we're already in the middle of, right? What do you think is going to happen to Bitcoin?
Is it going to pull Bitcoin with it?
It's not going to pump against it.
Okay.
Right? So even if you get your meaner version back to the 50, right? Let's say this isn't going to be a huge 2008 style collapse, which I'm not 1000% sure of. That was 2020. Oh, I'm on the 4 hour. No wonder. Hold on.
Yeah, because I was going to say, it looks like it's...
So, this is the bear market before. Let me see if I can make this make sense real quick. This was the bear market retracement before the stock market, before the real estate cycle turned. Right? This was the last bullish year before real estate in 2008, right, did the bad thing. S&P dropped 50%. On the year which it dropped, where it dropped, or on the year after the drop had already started, it dropped 58%. The cycle topped, the real estate cycle topped here. This is where we see the drop on S&P, right? The real estate cycle dropped at the end of 2006. Right here. Right? That's when the cycle officially was over. Where we are right now, right, is about 4 months away from that happening. So the question is, why are these so big compared to what happened after?
News-related incidents.
Right? So look, 17% is all you got for a drop on the first bear market after the stock market collapsed. And then the one after it, 21%. Notice it's scaling up. And then the one after that, 31%. And now we're back to the drop that happens before real estate drops, which is this one. Right? So my argument is, when you get the collapse, when that real estate gear finally turns, right, and it takes its final turn, and then it hits that commodity gear, it hits that 4-year cycle gear, the liquidity that comes from saving the world from this, right, all the money that got printed after 2008 is what has kept us afloat all this time. And you can tell because the year right after the printing, really small drop. And then as the money starts sort of wearing off, the effect of the money starts wearing off, you get an even bigger drop. And then now tons of time has passed since that, and you get an even bigger drop. So I think this is just the cycle of how S&P runs in between real estate crashes, right? So what I would expect is after real estate drops, the next S&P cycle that we have will be a small retracement during that bear market. And then that retracement will keep getting bigger and keep getting bigger and keep getting bigger until real estate snaps again. Now, luckily for me, as much as I love to put myself in positions to be wrong in 4K, it takes 18 years to prove me wrong on this. So good luck. But that's my thesis, right? And just looking at the past, that's sort of what makes sense. Now, what that means for us running forward is that I expect this drop to be substantial, right? More than the last one. The last one was 30-something%. So if we come down for a full correction, which is the 200, let's take all of this off the chart for a second. Look at this. So remember how I told you that the 50 EMA is your main mean reversion? Again, pretend we're on a 5-minute chart here. 50 EMA is your main mean reversion, right? That satisfies the need to return to the mean. But after a while, you need a correction, right? The correction takes you to the 200, right? Once you hold the 200, then you can go back to returning to the mean on the 50. But then eventually, you correct to the 200 again. Right? It happens over and over and over and over. Right? No correction for a long time here. Eventually, the need for a large correction. Right? Our 200 is sitting at 55 right now. Now, could this be a situation where we don't get a correction yet? Maybe, but the correction comes in the bear market, right? That's when you get your move back down to the 200. And this, in my opinion, is why so many crypto people have that idea that we're at our 200 and that means we must be at our bottom. They're listening to people from legacy. They're trying to take legacy rules and move them into crypto. Because if you look at Bitcoin, Bitcoin definitely doesn't react like that. Not on the macro. You're looking more of an 800 hit for Bitcoin. So, this, in my opinion, like I said, is a blow off top in one of the most important bull markets where everything is going to sort of deflate at the same time, right? Bond market, crypto, Forex, commodities, legacy, right? Everything's meant to pop at the same time. But this is how bubbles pop. Not the way we did with a whimper. Right? We came up and just, no, this is how bubbles pop. Right? You get your bubble, your euphoric bubble, and then this is why most people's top indicators for Bitcoin didn't trigger. Nah, it's not that it goes pop. It's just, it cycles, right? It'll cycle from main currencies to emerging markets, basically. But war, you saw what happened to my emerging markets plays when the war started. Look at how much money was coming into emerging markets as that gear was turning, right? Like, people made a decision, BlackRock, Fidelity, right? They made a decision when they cashed out on Nvidia that that money was going to move into foreign markets. And that's why I chased it, because you could see the evidence of it. But the problem is when World War III happens, this is a big dog game, right? This is when the major nations start sucking in all that capital. So who does it affect first? It always affects the emerging markets first. But peace hopefully will change that. you know. But so my point is, even if this doesn't correct back to the 50, right? Even if it just comes back down, I mean, if it does correct to the 50 and then whatever, what does Bitcoin do? If S&P drops 10%, and this is just me being bullish, saying, okay, yeah, super cycle, S&P will never have a bear market again. Super cycle bros are right, even in best case scenario. Well, let's see what happened the last time it dropped. Right, what was this drop here? Like 20%. %33 drop. So like 2 to 1, right? You're already at 49. And it's not just ES. Right? It'd be great if it was just ES. Right? It's not just ES, it's NQ. Always do that. Why'd I always do that? Like, people don't realize how, especially on ES, this move on ES was the most parabolic move that it's had since 1950. But maybe this time is different. Look at NQ. This was our drop 2008. This was the bear market before real estate went down. Again, I'm not saying this is going to happen, but give me a quarter of it. Right? Give me just a quarter of it. If big money didn't understand that this was going to happen, the commodity wheel wouldn't be turning. Because they bled Bitcoin, basically. When the war started, think of it like this. The war starts, obviously there's money in war. Everybody knows that, right? So big money is like, where do we put our money? Can't put it in silver. It just got manipulated. The shit. Can't put it in gold. Let's put it in oil. They put it in oil and then got wrecked. They're still getting wrecked right now. Stuck in paper contracts, sitting underneath 90 on deliverables that they can never get, when the actual true value of oil is still sitting above 114. And it's actually more than that when you take into consideration transport and storage. So what do, right? They kept getting slammed down on oil under 100, and Bitcoin's looking great on support, right? So they slammed it into Bitcoin. We saw the money come in. We saw market makers step in and keep them from getting to a certain level, and they didn't hesitate. Right? As soon as good news, look, not to be too not to be too tin hatty, but this shit is obvious at this point. This is the weekly cycle we've been running. The weekend. Right? Bad news. Bitcoin goes down. Stock market is paused. We get to the middle of the week. Tuesday, Wednesday, wait for it. Tomorrow, the day after, it'll come. Good news. Stock market gets to react to the good news without taking the dip on bad news. While Bitcoin just catches up to where it dropped from, maybe goes a little bit higher. Right? Starts to look really, really bullish, like it's going to break out. Everybody's getting excited. Weekend comes, bad news. Ceasefire canceled, ceasefire on, ceasefire canceled. All right. Stock market is still running, takes a natural retracement into the weekend. Isn't on for the bad news. We are. So we eat the bad news. And then it starts all over. Middle of the week comes on. Good news. Stock market gets to react to the good news without ever having to react to the bad news. Bitcoin barely makes it back up to where it was. Double tops off of macro support. They're pulling us around by the hoo-has. Right? We're the punching stick. We get to absorb all the bad news so that legacy can move freely. Unfortunately. For them, it's a win-win, right? Because they're bubbling up their money on legacy to buy crypto once it gets to the bottom. So, you get what I mean? Like, they're cooking with both hands right now. They're eating on their shorts on the weekend. And then they're bubbling up dry powder. By the time legacy tops out, they'll pull that dry powder out. Wait a couple months till Bitcoin hits bottom. We run it again. Right before Trump announced the peace talk, that the peace talk was successful, when he said all those nice things, somebody took out a multi-billion-dollar long on oil futures. Right? The price of paper oil went through the roof. Dude made generational wealth. Right? It's happened 3 times. 3 times in the past 2 weeks.
Yeah, dude, I think this one's gonna go to court though.
3 times. And everybody keeps wondering why it's so on and off. Why is it? Oh, it's on, it's off again. It's on, it's off again. Why? Because they are getting to the bag on every single one of those. People are going absolutely crazy on Polymarket right now. Well, just think of it. If you know a peace talk a peace talk announcement's about to come up, right? Which means that people are going to assume that the strait will be open, which assumes that price will then, now, come down or whatever. Then you get to counter trade that position, right? You understand that price going down isn't accurate, right? The price of oil. I want to show you something that I watched. We really do have to start getting into a react segment because there's a lot of shit I see that I want to show y'all. But there was an oil conference in Dubai, and there was this dude from there who was talking. And these are like, it's just a room full of sheiks and shit. And he was saying, he was talking about the discrepancy, right, in the oil. And it's funny because he sounded like me. Like, remember when we were talking about silver, and I was like, nowhere on the planet can you buy an ounce of silver for 80. If you can find an ounce of silver for 80, tell me, and I'll clean them out, right? He was saying the same shit. He was like, $90 for paper oil. He's like, everybody in this room knows that there is not a place on the planet where you can go get a barrel of oil for $90, have it delivered, shipped, and stored. It's absolutely impossible. But this is what we're talking about, right? And what they're doing is this is just more manipulation. I hate to listen. I'm not even going to point fingers. Y'all can point fingers at whoever you want. I'm just telling you what's happening, right? They are manipulating oil prices to make people think that there's nothing wrong with the stock market, right? This is why the stock market's making the move that it's making. Because people understand that oil above 100 is unsustainable and that's dangerous for everybody, and everybody runs for the hills. But if you can keep paper oil at 80 or 90, right, and then everybody's like, well, it's under control. Obviously, the peace talks are happening. Like, look, if it's down, it's peace, right? If it's down, it's peace. If it's up, it's war. Yeah, but you're looking at the wrong chart. And this has less to, obviously, it has to do with making money on oil, but it has to do with keeping that legacy move going, right? And it's a clear, you can see it as soon as it's manipulated, like even if we throw it on the chart. But this is what's scary about it, because if you throw it on the wrong chart, that look like a coincidence to anybody? That's why it pumped the way it pumped. Because we're feeding people a load of bullshit about what the next 6 months looks like. Like I just said, 420, while we've been waiting for 420 to roll up, macroeconomists have been waiting for 420 for the past 2 months, because the last ship to leave the strait before any of this happened that was carrying oil at regular prices gets to its port today. Which means that this is when the world starts to feel the effects of all of this. When they look out across the water and there's not another tanker coming.
Yo, Jay.
Yeah.
I don't see how, like, I don't know, maybe you can break it down, but if that's going to, whatever, say England or whatever, how could, like, all these people be worried about the one last tanker landing as opposed to, the one that's going to this country, or, you know what I'm saying?
Well, it was just, it was a line in the sand. It was a line in the sand that was drawn, and they're just calling it post-conflict tankers, pre-conflict tankers, post-conflict tankers, right? Which means that there was no restriction on any movement at that time. From now on, any tanker that gets through had to make it through that, right? They were stalled. So that means that those shipments aren't coming regular anymore. They're going to be very sporadic as they start coming in. And some places are affected more than others, obviously. Places that have reserves are going to be able to take it longer than others, places that don't. But just think about what that means, right? The last tanker hadn't even landed yet. We're already paying $6 a gallon for gas. And we have reserves, right? They keep telling us not to worry about it. that we've got all these major reserves and that it's not going to affect us. I don't know. I don't see that when I go to the grocery store, and I don't see that when I go to the gas station.
No, me either. But what I was thinking, or what is whatever the idea in my brain is that the gas stations didn't take no time to raise prices as soon as this conflict started.
Yep.
So we're already feeling that, you know,
Yep.
the truckers aren't paying a discounted price, you know, because they're industrial or whatever, you know, they're paying the same price we're paying. So the cost of getting food to the store or whatever goods are being transported, that price is already going to be pushed forward.
Yep.
But also another thing, supposedly a week ago or whatever, a bunch of ships turned from Iran and they started heading to the U.S. supposedly to start buying oil here. And yeah, just wondering how that whole thing works. It's like,
so when you look at our reserve, because that they've been saying that a lot, but when you look at our reserve, there's two problems. One, our reserve is not at its highest level. We don't have the oil to just be selling to the world right now. Two, the reason that we can never be the main supplier of oil to the world, even if we have like oil sands and all of this, you know, even if it's technically there, is because we're the biggest consumer, right? It's like getting high on your own supply. Like the best Coke dealer is never going to be a Coke addict, right? We are addicted to oil in this country, which means that we're always going to export. I mean, we're always going to import more than we export. This was just a failed mission, bro. I hate to say it, but this was an attempt to weaken China, right? We went to Venezuela. We made sure that we got all of that oil in Venezuela, one. And two, we made sure that China wouldn't have access to that oil in Venezuela, knowing that that's their number 2 gas station. Then we attacked the number 1 gas station. And we thought that applying pressure in the Strait would weaken China, right? Because they wouldn't be able to get oil. And we thought that the conflict wouldn't last long. The conflict not only lasted long, but they started taking bribes in Chinese yuan to get through. They started letting Chinese tankers through. That in my opinion, it didn't play out the way that we thought it was going to play out.
to switch gears, I've been using Bobby to help me be more aware of the count that we're in. Market Maker Fractal I'm speaking of.
Okay.
And so I've been doing whatever the prompt. I want the 5, the 15, and the 1 hour fractal, you know, and if, you know, which they've all been aligned, whatever, up to now, or still whatever. However, he's saying that we're in push 2, and this is just a, you know, a correction. Now, I trust your opinion more than, you know.
I hope so. Yeah.
But that
are you
said,
showing? Are you taking screenshots of the chart?
No.
All right. Don't trust that they can. Yeah. Don't trust that they can see the chart. If you're gonna talk to AI about a chart, this is just from my experience, right? Because there will be times that they're plugged in and they're getting it right, but there's other times where they'll just give you an answer. They might be looking at old information. They might even be looking at a wrong chart. So what I like to do, if you're gonna do it, is take a screenshot of the chart. Take a screenshot of the chart and then add the chart on the little plus, and then you can ask them what you want about the chart itself. But yeah, I don't doubt it. I mean, like I said, there is some subjectivity to the counts. You know, as much as I make fun of Elliott traders, like we are, you know, people will disagree on what count we're on.
Yeah, I've been laughing about that myself. Again, all that to say, this M, the bigger M, we only pulled to the 382, right? Which is a shallow M, or whatever, bullish or bearish M. Now, I was like, normally I'd be like, all right, well, if we invalidate this M, I'll just consider this the third push and I'll take my hedge off, which is the whole reason why I'm like concerned over this, because whatever.
You
Got a
hedged.
lot of money into a trade,
Yeah.
and I had a hedge to keep from being potentially liquidated. But so I'm underwater on my hedge, and I don't like it. I want to get out, but again, I don't want to get out only to have it do exactly what I'm worried about and whatever. So again, in validation, I would say normally would be like 76, which would be the top of that lower part of the M. But being that it's only a 382, you know,
You
what
could be
would
putting in a bigger M. Yeah.
yeah, that's what I'm concerned with.
Yeah.
So again, what would you whatever advice you have or whatever, if you were doing it yourself and you were in this predicament, how would you handle that?
So it depends on your account, right? So like let's look at just from the top. Well, you said that he says that we're in 3, so let's show first of all why we're not. It'd be easier to see it
And
on
I
the.
also,
Go ahead.
and I also have a habit of saying I need up to the minute price action. I need you to check the tape.
Yeah, it's a good idea to do that, but even then,
Because
sometimes they get it wrong.
I've gotten where they were like, oh yeah, it gave me wrong numbers, and then I upped it, I let them know, and then they were like, oh, pardon me. And then, so that's just something I do every time I ask. I'm just saying, all right, I need you to look at the tape right now.
Yeah.
Give me kind of up to the minute price action, whatever.
So looking at it, right, just to count so we can get on the same page. You got your W, your rise one that comes back and tests the 50, right? And then your next high that has a deep correction, your rise 2, and then your rise 3. Right, so just like that fractal is on different time frames, the M will also be. So let's look at our M fractal from the top, from the micro to the macro. So on the micro, you've got your M, your drop 1, drop 2. And you're looking for a drop 3 at this point. On the 15-minute, you dropped your M there, right? And you're on your drop 1, but we're past the 50. Right, so this is more than just a retest. This could still be your drop 1 retest, but you can't take out this high. If you invalidate that, then what you said earlier, right, is what it is. This is your deeper sort of retracement, and then you're still looking for that 0.5 or that golden pocket. Right, but the sketchiest part of type 3s are the retracement on the M, because you don't know until you break that M. If it's like, let's say we come up, right? Let's say we come up and we hit that golden pocket. You don't know on the way back if it's just going to hold and then have a continuation, right? So when you're in that range of your type 3 range, this is the smaller one. On the smaller time frame, we've already got that break, drop 1, drop 2, right? So you're expecting that drop 3. On the bigger time frame, your range is this, right? That's not enough yet, which means you could still come out and build there. So yeah, there's no easy answer. In other words, like you literally just have to watch the range and see the structure. For me, it still looks like we are like we're dispersing, but we do have a bullish structure here to contend with. And not to mention, I'm still long. I've told you, I'm long into CME on a 3-day swing. I'm not really worried too much about compounding on this day trade. If it does come down, though, and we get a full sort of retracement, then I will probably add to it. for that larger W break. That type 2, basically be a type 2 entry.
Which is what I was planning on doing. But,
Yeah.
I'm on higher levels than I should be. So I just wanted to,
Yeah, that would be the next place that I would be interested. Right. Not only would it be a decent type 2, but it would also be a retest of that downtrend. Right. And if that holds with volume, then there's a good chance, especially if we haven't taken CME yet, right? There's a good chance that it comes back, builds that liquidity that we need for that sweep up to CME, takes care of that, and then ends up putting in the larger M structure at the top of the macro third push that we're in. I know this is a lot, y'all. I promise that eventually it'll get to the point where it's automatic and you're holding the different time frames in your head. But it's a lot. Even going through it and explaining it right now in the back of my head, I'm like, yeah, this is a lot. But that move would in turn, you know, we just, if this, then thatted the whole W pattern that brings us up to take CME, right? If we get that move on CME, then what I'm looking for is this M pattern that then drops us back down underneath 70. Right. And that would be, just to put a bow on it, I know this shit's sloppy right now, but that would be your W pattern. Rise 1, retrace. Rise 2, retrace. Rise 3, M pattern. Drop 1, drop 2, drop 3. And that's what we mean by working from the higher time frames down to the lower time frames, right? Always knowing where you're at on the higher time frames and how the move that you're making on the lower time frames fills out that higher time frame chart. So you don't get excited about a move up that's literally just giving you the lower high on a, you know, on a macro. Or the opposite, right? You don't get excited about a move down that's just giving you a type 2 on the 4 hour.
I'm sorry if I didn't catch it. Pertaining to an invalidation on this, on that M, should I wait for the 0.5 head or just break in this M top, or maybe even wait?
I mean, it depends on how you want to play it. Me personally, when it comes to type 3s, if I'm taking a type 2 and I mean not type 3s, when it comes to the third push, right? And we're trying to figure out if it's going to be an M or if a W is going to fractal out. I obviously try to catch, you know, the snipe as much as possible because I want my stop loss up here, so that if it does range, I don't get stopped out because of the range. But because of that, what I tend to do is when I take my type 2 entries, I will put their stop above type 1. Right? It gives you a bit of a bigger stop, but it also allows you to drop more size in the trade. Right? By the sizing calculator, it allows you to drop more size in the trade, and it keeps you safe from the possibility of a continuation. Right? And then if it goes, and you get stopped, whatever, right? You swung, you failed, no big deal. But it avoids getting stopped out, like, you know, having this get taken out, then it just goes to golden pocket and then finally does the thing. And you're like, oh shit. So personally, at this point, you just, in my opinion, have to wait to see how it plays out. If it stops you out, then you'll have to take another type 2 entry on that golden pocket, you know? I personally do not move my stops backwards, ever. So I can't sit here and tell you. I can't sit here to tell you to move your stop up because I wouldn't do it. Stops only get moved up. Right.
Is that because it gets more volatile at the top and you can get stopped out easier? Is that why you don't?
Yeah, that and it's a bad habit to get into. Moving your stops uh, from where your original idea was is a good way to talk yourself into being underwater. Because there'll always be another reason to move. You know what I mean? They'll start coming down. You'll be like, you know what? Well, maybe it's gonna hold the 200, and my stop is above the 200. You know what I mean? I put my stop in a bad place. It's probably gonna come. I'm gonna move my stop underneath that 200. Screw it.
Oh, I see. I
And
thought you
then it
said move
fails,
up.
and then you're like, oh, I'm gonna. Well, just away, right? Moving it away. You can always move it closer. Moving it closer is fine. You're locking in profits by doing that, right? But moving it away, you're adding additional risk that wasn't there when you first took the trade. So like maybe you took a good risk reward trade and you have a good size and you're only risking 1% of your position, right? And now you're risking 3%, and now you're risking 5%. So you screw up your entire risk calculation. Yeah, slowly that'll kill you. Slowly you'll just bleed out doing that. It's hard, but I just take it as a lesson, right? If I get stopped, I take that as a lesson. Okay, in this situation, next time, boom, no big deal. Your stop should be an acceptable loss, anyways, right? So the only annoyance is having to get back into that type 2 entry that you were already sort of comfortable in, especially after seeing the floor break. It's like, you know what I mean? You're like, okay, this is good. And then you get this, like, oh, shit. Yo, how is it 9 o'clock already? What? Go to sleep, H. Yeah, I'll check my DMs. Then I gotta get some food, man. I was about to just skip dinner. Nah, I was wondering why I was feeling that way. Like, yo, I'm like super off right now. All right. Do this like this. Only 15 minutes. Yeah, I know, Eric. I get to yapping, bro. That's how y'all know I really love this shit. No problem, y'all. I'll be back. Bitcoin dominance is casually above 60%, by the way, if anybody hasn't noticed. Careful with your alts. What's good, Joe? All right, I'm done with research. I just dropped the Cypher briefing on oil, and I'm about to let the podcast, I'm about to let the AI tear it apart live in 4K, so let's see what they think.
Forgettable scene in the movie Interstellar.
Oh yeah, the water planet.
Yes, exactly. The crew lands on this entirely new planet, and it's just shallow water as far as me eye can see.
Right.
And they look out at the horizon, right? And they see these massive towering peaks. And one of the astronauts says, "Oh, look, mountains."
Right, because they're looking for land.
Exactly. There's this brief moment of absolute relief. But then as they stare at it, the realization just kind of hits them. Those aren't mountains.
The horizon is moving.
The horizon is moving. It's an absolute gargantuan, planet-wide tidal wave, like an interstellar tsunami.
Yeah.
And it is coming right for them. And by the time they realize what it actually is, it's almost too late to get off the beach.
Which is such a perfect...
Oh, hey, welcome. What's up?
What's going on, guys? Didn't want to cut you off. I'm going to let you go. I just want you to know it's Dbloc. I put together the report that you guys are going to be covering. So be kind, but be honest.
That is fantastic, man.
Wow, you are the man. What an incredible surprise.
Thank you for joining in.
We absolutely appreciate you chiming in.
We're just starting to dive into the core research you compiled.
And seriously, thank you for putting this together.
We are going to be very honest.
But absolutely kind, of course.
Because the analysis you've aggregated here is genuinely alarming.
Yeah, that interstellar analogy you used.
It's perfect for human psychology.
But we were just saying that the human brain is hardwired to look for stability.
When we see a massive shape, we assume it's bedrock.
Right, a mountain. We really don't have the mental models to process a wave of that magnitude.
And that psychological blind spot, which is really your whole thesis here, is the focus of our deep dive.
Because, as you pointed out in the report, the global economy is standing in that exact same shallow water.
We are mistaking a completely shattered oil supply for market stability.
We think we're looking at mountains.
But it's a massive physical wave.
So our mission today is to use your excellent report to give our listener the radar to see that wave for what it actually is.
Well, before it hits their local gas station and, their grocery store.
And to really give them that radar, we have to completely deconstruct how the financial markets are currently functioning.
Or, well, more accurately, malfunctioning.
Malfunctioning is definitely the word for it.
Yeah. We are going to look at the extreme disconnect between paper promises, the stuff traded on Wall Street, and the actual physical atoms.
The reality of the supply chain that you detail in your work.
So let's start with the most dangerous assumption of all.
The one you highlighted in your section on the net exporter myth.
To understand why this wave is going to be so devastating, we have to look at why Americans feel so safe standing on the beach.
Exactly. If you turn on any financial news network today, you will hear one phrase repeated constantly.
The United States is a net exporter of oil.
We are told we are energy independent. The fortress is secure.
It's a very comforting narrative. It sounds great on television.
Yeah.
But when you actually look at the physical arithmetic, the fortress walls look paper thin.
How so? Because the data in your report is quite specific.
Well, the net exporter label is technically true when you bundle refined products.
Oh, I see. When you mix gasoline and diesel with crude.
Exactly. But if we are talking strictly about the raw physical crude oil that feeds the machine.
The data shows the U.S. imports roughly 6.3 million barrels of oil every single day.
Yes, while exporting about 4.1 million barrels.
Okay, let's just do the basic math there.
The math exposes the deficit.
Because if we are bringing in 6.3 million barrels and sending out 4.1 million, we are in the hole by 2.2 million barrels a day.
Exactly, 2.2 million.
Basic economics says we are a net consumer.
It's like a baker who sells 4 cakes a day but personally eats 6 cakes a day.
Yet claims he's feeding the whole neighborhood. The math just doesn't work out.
The problem is that the U.S. is still structurally dependent on foreign crude.
Right, and that's because not all oil is exactly the same, is it?
Far from it. Most of the oil we pump out of the ground here in the U.S. is light, sweet crude.
Sounds like a coffee order.
It really does. It's high quality, but our massive refineries built along the Gulf Coast decades ago.
They were engineered to process something else.
Exactly. They process heavy sour crude.
That's the thick, sulfur-heavy oil that comes from places like the Middle East and Venezuela.
So we ship our light oil overseas, and we buy heavy oil from foreign countries just to feed our own refineries.
That is the physical reality of the supply chain you outline.
We are tethered to the global market by our own physical infrastructure.
So when the public believes this energy-independent myth, They just don't panic when global supply routes are threatened.
Right, because they assume we can just keep our oil for ourselves. They think, no problem, we've got Texas.
They don't realize that shutting off the global taps leaves us short 2.2 million barrels a day of the specific chemical composition we actually need.
It's a massive blind spot.
But wait, that brings up a massive logical contradiction then.
Yeah.
If we are running a daily deficit of 2.2 million barrels, why aren't the prices reflecting that?
The oil ticker I checked this morning looked perfectly stable, hovering right around $100.
If we are secretly in the hole, why is the price on the screen so calm?
To answer that, we have to look at the financial system itself.
The hard, sharp line you draw in your report between a paper promise and a physical atom?
The $100 price you see on your screen that is Brent futures, it is essentially paper oil.
Okay, let's unpack this mechanism because this is where the source material gets genuinely alarming.
Think of a futures contract as just a digital agreement. It says, I promise to sell you 1,000 barrels of oil at this price in the future.
It's a contract.
Exactly. But the vast majority of people buying and selling these contracts, they are not oil refineries. They are hedge funds and speculators.
They never intend to touch a single drop of actual greasy physical oil.
They're just betting on the price movement, like a casino.
But the report points out that if you are a real nation that needs a physical barrel delivered in the next 10 to 30 days,
You are absolutely not paying that $100 paper price.
you're not.
No. You are looking at a totally different market called dated Brent, the physical delivery market.
And in that physical market today, the price is $130, $140, or even $160 a barrel.
Yes. And that gap, that massive spread between the paper promise and the physical reality is the warning siren.
Wow, the physical price is at $160 while the screen says $100.
Yes, the source includes a historical chart from JP Morgan tracking this exact spread over time.
What does the history look like?
Historically, the paper price and the physical price essentially held hands.
They move together, maybe a dollar or two apart.
Even a $5 spread was considered a sign of extreme, unprecedented market stress. People panicked over $5.
But today, according to the data in your report, the gap isn't $5.
No, it's $35.
$35. That is the single largest spread in recorded history.
It's like booking a hotel room online for $100, but when you show up, the manager says, if you want an actual physical key, it's going to cost you $160 in cash.
That is a perfect analogy. The paper says one thing, reality demands another.
But why is the paper market pretending everything is fine? Why the massive disconnect? Well, the source outlines a very compelling theory here of active market manipulation.
Driven by massive, strategically timed short selling.
It's a fair question why this is happening. The evidence lies in the timing and volume of the trades.
Right. For the listener who might not trade commodities, let's quickly define short selling.
Normally you buy hoping the price goes up, but if you believe the price is going to fall, you can short it.
You borrow a contract, sell it immediately, and then buy it back later at a cheaper price to pocket the difference.
Yes, but here is the critical mechanical part of this.
When you suddenly dump millions of dollars worth of borrowed contracts onto the market to sell all at once,
You drastically increase the supply of paper oil available for trade.
oh, I see. Supply goes up, demand stays the same, so that sudden flood of supply mechanically drives the paper price down.
Supply and demand. Now, according to the data tracked in your source, massive $100 million short bets have been placed at incredibly, almost suspiciously specific moments.
Like when the source tracked one occurrence exactly 20 minutes before a major political announcement claiming the conflict was stabilizing.
20 minutes. So you're saying someone knew the announcement was coming.
They flooded the market with paper oil to artificially suppress the price right beforehand.
And then let the political announcement reinforce the illusion of coal.
The source identifies this exact pattern happening at least 3 times since the current conflict began.
So whether it's government intervention or highly sophisticated front-running by hedge funds, the mechanical result is exactly the same.
Which is what?
The paper market is being used as a psychological suppression tool.
It calms the stock markets and allows political leaders to project stability.
But there is a fatal flaw in that strategy. Unlike a stock, an oil futures contract has an expiration date.
Eventually, the music has to stop.
And that is the moment of reckoning. When a futures contract expires, it requires physical settlement.
The buyer holds up their digital contract and says, okay, the date has arrived. Where is my physical oil?
But the entity that shorted the oil has zero physical oil to deliver.
So what do? They are legally obligated to deliver oil they don't have.
They are forced to go out into the real-world physical market, the dated Brent market, and buy actual oil to fulfill their legal obligation.
Oh, man.
But remember, the physical oil isn't sitting at that artificial $100 price. It's at $140 or $160.
Oh, wow. So they have to buy it at a massive catastrophic loss.
Exactly. We're talking billions in potential exposure.
And this mechanism triggers what Wall Street calls a short squeeze,
A forced buying event that hits the physical market.
driving the physical price even higher. And as the physical price skyrockets, the paper price is violently yanked upward to match reality.
It snaps back. You simply cannot indefinitely suppress the price of a physical commodity using paper derivatives when there is a genuine shortage.
The laws of physics will always eventually break the laws of finance.
Which brings us perfectly to the physical shortage itself.
We know the price on our screens is an artificial mirage.
So let's look at the underlying reality causing this panic among the people actually buying physical barrels.
Let's talk about the plumbing of the global economy, specifically the Strait of Hormuz.
Geographically speaking, the Strait of Hormuz is one of the most vulnerable choke points on the entire planet.
Yeah, it's this narrow waterway nestled right between Iran and Oman.
At its narrowest point, the shipping lanes are barely 2 miles wide in either direction.
And roughly 20% of the entire world's oil and natural gas flows through that 2-mile gap every single day.
1/5 of global energy. It is the absolute jugular vein of the global energy matrix.
But the source material details an even broader, deeply unsettling phenomenon happening alongside this.
You mentioned the pipeline virus in your report.
Yes, since March, the data shows dozens of energy pipelines and critical infrastructure nodes across the globe mysteriously catching fire or exploding.
It points to a massive systemic degradation of the physical pathways. The global circulatory system is failing.
Let's put some hard numbers to that failure because the math the source provides is just staggering.
A healthy global economy consumes roughly 100 million barrels of oil every single day.
But due to the constriction at Hormuz and these cascading infrastructure failures, the source calculates a missing baseline of 8 to 13 million barrels per day.
That oil is simply not arriving to the market. It's gone.
Let's contextualize 8 to 13 million barrels because those numbers are so big they just stop feeling real.
Right, it just sounds like a lot.
Yeah. The United States consumes about 20 million barrels a day total.
So a global deficit of 10 million barrels means the world is suddenly losing the equivalent of half of America's total daily consumption.
Every single day. And one energy fund manager in your report estimates the total loss to the global system will reach 780 million barrels.
780 million. That is 780 million units of economic energy permanently erased from the earth.
Insane. Now, the natural assumption most people make is to rely on government safety nets.
Exactly. They point to the Strategic Petroleum Reserve, the SPR.
But the source data shows the SPR only holds about 400 million barrels right now.
And it was already heavily depleted before this current crisis even started.
Exactly. Even if the U.S. government completely drained the strategic reserves down to absolute zero.
Which they would never do because that leaves the military with nothing in a direct war.
But even if they did drain it to zero, it wouldn't even cover half of the total estimated global shortfall of 780 million barrels.
It's a drop in the bucket. And if we look outward to global spare capacity,
the amount of extra oil countries can pump if they open their physical taps all the way.
The numbers offer absolutely no salvation. The U.S. can surge maybe 1 million extra barrels a day. Venezuela and Canada can push perhaps another million each.
So if you add up every emergency pump and every alternative pipeline on the entire planet,
you get maybe 2.8 million barrels a day at best.
Against a gaping daily deficit of 8 to 13 million barrels.
The math of the emergency reserves simply does not match the math of the wound. We're bleeding out.
The medical analogy is really apt here because it highlights a critical distinction we have to make between different types of economic shock.
We need to distinguish this from the chaos of 2020.
Oh yeah, when the price of oil actually went negative for a few days during the COVID lockdowns.
Right, that was a demand collapse. The world simply didn't need the oil, so the price evaporated.
Right. But what we are experiencing right now is the exact terrifying inverse of that.
This is a supply emergency.
The demand hasn't gone anywhere. The demand is ravenous.
The trucks still need to move the food. The power plants still need to keep the lights on. But the physical fuel to run that machinery simply does not exist.
In a demand collapse, the machine just pauses and waits.
In a supply emergency, the massive gears of the global economy keep trying to turn, but they have no lubrication.
They start grinding against each other, sharing metal and tearing the machine apart from the inside.
It is a far, far more destructive and intractable economic problem.
Okay, so if the math is this catastrophic, I just have to ask, where is the pain?
Why is everything seemingly normal when I look outside?
Why isn't Wall Street melting down right now?
Because the pain is dictated by geography and supply chain lead times.
The source provides a chilling timeline of how this tsunami is already making landfall.
It just hasn't reached the American beach yet. We are essentially watching a chronological series of dominoes fall across the map.
And the first domino to collapse was Asia?
Which makes sense geographically. Asia sources roughly 80% of its total oil consumption directly from the Persian Gulf.
And the flow there has been utterly devastated. The data shows that only about 6% of pre-war volume is currently managing to squeeze through to Asian markets.
Only 6%. Imagine taking 80% of your total daily caloric intake and suddenly reducing it to 6%.
The biological shock to the system is immediate. And we aren't just talking about abstract GDP numbers here.
The report gets into the actual ground-level human impact.
Look at the Philippines. They were among the first to react, declaring a national state of emergency because the price at the pump more than doubled almost overnight.
It instantly paralyzes mobility, and we are seeing governments take draconian steps to manage this paralysis.
Look at Indonesia and Vietnam. What are they doing?
They have instituted mandatory work-from-home orders.
Mandatory, but not for public health. Purely for energy rationing.
They physically cannot afford the fuel required to support a daily commuter workforce.
And the detail about Thailand's fishing industry really struck me.
Yeah, that's 1% of their entire national economy.
The source reports that this sector is effectively shutting down because the cost of marine diesel fuel has spiked by 250%.
The fishermen literally cannot afford the fuel required to leave the dock. They would lose money trying to catch the food.
And when the fishermen can't leave the dock, you introduce the next massive shockwave: food scarcity.
Look at India. The government was forced to halt commercial supplies of liquefied petroleum gas, or LPG.
Cutting off the supply to businesses in a desperate attempt to protect the remaining inventory for household cooking.
Exactly. The source notes that by early March, approximately 20% of hotels and restaurants in Mumbai had already been forced to close.
Because they simply couldn't get the basic fuel to fire their stoves.
And the wave doesn't stop there. After crashing over Asia, it moved westward toward Africa.
According to the timeline, regular deliveries to African ports effectively ceased around April 10th.
And the desperation there is even more acute. Countries like Ethiopia, Zimbabwe, and South Sudan aren't just rationing fuel anymore.
They are actively diluting their remaining petrol.
Yes. They are stretching their gasoline supply by mixing it with harsh, non-standard chemical solvents,
which actively destroys internal combustion engines.
They are sacrificing their long-term transportation infrastructure just to keep the lights on for one more week. It is sheer desperation.
And moving even further west, Australia and Europe received what are likely their final normal shipments in mid-April.
Europe is now engaged in a desperate scramble to proactively kill domestic energy demand.
Because the cheapest energy is the energy you simply do not consume. All of this paints a picture of a world that is already in the grip of a profound crisis.
Which forces me to stop and ask the most glaring question of this entire deep dive.
Okay, what is it?
If entire sovereign nations are declaring emergencies, why is this not the lead story on every single screen in front of us?
Why does it feel like a secret in America?
It all comes back to the physical buffer of the global supply chain.
The World Energy Network is not a digital fiber optic cable traveling at the speed of light.
It is an incredibly vast, slow-moving conveyor belt of massive steel ships crossing vast oceans.
It takes weeks to cross the globe, so the sheer size of the ocean acts as a buffer.
Exactly. When the valve gets shut off in the Middle East, the ships that were already loaded just keep sailing.
To the country receiving those ships, everything looks completely normal.
Right. The physical delay in shipping creates a psychological delay in the public narrative.
Which brings us to the American beach. The reason we feel so immune right now is simply because the United States is at the very end of that global conveyor belt.
We are the last stop.
But that buffer is a mathematical countdown. It has a definitive end.
And the source actually provides the exact JP Morgan timeline for that countdown?
They tracked the final crude cargoes traversing the globe.
The last normal shipments arrived in Texas around April 1st, and they reached the California coast on April 8th.
But JP Morgan mapped the precise expiration date of the buffer.
They tracked the very last oil tanker to clear the Strait of Hormuz before the closure on February 28th.
And based on standard maritime shipping speeds, that specific vessel reaches its destination and is consumed by the global economy around April 20th.
April 20th represents the mathematical moment when the global system runs entirely dry of the old inventory.
So according to this timeline, the U.S. economy is currently Wile E. Coyote.
Yeah, that's exactly it. We have just sprinted off the edge of the canyon, fueled by the last fumes of the pre-crisis inventory.
And we simply haven't looked down yet to realize there is no ground beneath us.
That is exactly the mechanism at play. April 20th is the moment Wile E. Coyote looks down.
And the rules of gravity reassert themselves, boom.
And remember the $35 gap between the paper price and the physical price we talked about earlier?
Yeah, the short squeeze.
Without the buffer of incoming ships, the paper market can no longer maintain the illusion.
April 20th is the catalyst for the violent convergence. The paper price has to meet the physical price.
The illusion shatters. But this leads me to a major point of confusion.
We are supposedly days or weeks away from this mathematical cliff.
Yet the stock market, the supposedly omniscient pricer of future risk, is sitting at all-time highs.
How is Wall Street completely ignoring a 10 million barrel a day supply shock?
You would think so. But to understand the market's delusion, the source argues we have to look at the only metric that matters: historical precedent.
History.
The market is ignoring it because it literally lacks the historical imagination to price it in.
We can see this clearly by comparing today to the major supply shocks of 1973 and 1990.
Let's break down 1973. During the Arab oil embargo, only 7% of the world's oil supply was taken offline.
Just 7%. And the mechanical cascade that followed was...
Oh yeah, let's hear it.
So you guys are about some of the macroeconomic.
We are absolutely...
Oh, back to our listener. What's up?
So you guys are about to touch on. I mean, ridiculous. Everything down to the decision the Fed has to.
That's a huge point.
Oh, we are right at the historical comparison.
You nailed it. We were just about to dive into the 1973 case.
You've already identified that the current supply shock is unprecedented.
But the similarities you mentioned to the macroeconomic climate, especially surrounding the Fed, are critical.
It connects directly to the bond market discussion in your report.
Yeah, if you look at 1973, that crisis led to rampant inflation, peaking at 12.3%.
Right, and today, rising oil prices drive inflation, which handcuffs the central bank.
The same dilemma the Fed faced then, they face now.
If they cut rates to support the stock market, inflation spirals higher.
If they hold tight, the high borrowing costs could trigger the death spiral.
You are absolutely right. The decision the Fed is grappling with is the exact same painful choice.
They are caught in the same inflation trap as in the 70s.
It's the ultimate feedback loop.
So let's go right into those historical results we mentioned.
We can't price in zero risk when the supply loss is 15 to 20%.
In 1973, when only 7% of supply was offline,
The cascade that followed was devastating.
the price of oil spiked by 300%.
We saw massive lines at gas stations.
The S&P 500 collapsed by 52% over the following 23 months.
That was all from just a 7% disruption.
And we saw a very similar, though slightly shorter, dynamic in 1990 during the Gulf War.
Again, about 7% of global supply was disrupted.
Oil shot up 75%, the stock market dropped 21%.
Okay, now let's apply that historical math to the current crisis.
How much supply is currently offline?
According to your source data, it's not 7%.
No, it's 15 to 20%.
The current disruption is more than double the severity of those crises.
The magnitude of the current shock is entirely unprecedented.
Yet, Wall Street is sitting at all-time highs.
They are pricing in zero stock market corrections.
The financial narrative is betting that a 20% supply shock will resolve with zero collateral damage.
It seems like pure delusion.
That
The
doesn't
source
make
points
any
out that
sense.
This exact same delusion happened in 1973, too.
It didn't crash immediately.
After a brief initial ceasefire, the S&P 500 actually went up by 2.3%.
The analysts looked at the political headlines, declared the worst was over, and just kept buying.
Because it took weeks for the physical reality of the oil
Does that sound familiar?
to earnings reports.
Exactly. The market had no mental model for a 300% surge in energy costs.
We are living through that exact same psychological lag today.
The source visualizes this psychological split with an incredible chart,
It maps the S&P 500 against the University of Michigan Consumer Sentiment Index.
which is just a measure of how ordinary people feel about the economy.
Historically, those two lines are mirror images of each other.
When the stock market goes up, consumer sentiment goes up.
But right now, the S&P is near all-time highs.
And Main Street sentiment is at its lowest point in years.
The gap between Wall Street and Main Street is massive.
The person at the Bloomberg terminal disagrees with the person filling their tank.
And historically, the person filling the gas tank is always right.
But the implications of this shock go far beyond the gas pump, right?
They absolutely do. This energy crisis hits the oil-to-food pipeline.
Yeah, fertilizer, natural gas is the primary feedstock for urea.
And the disruption at Hormuz is spiking fertilizer prices to 2022 war levels.
This will manifest as a massive spike in grocery prices.
But with a 6 to 12-month delay, the food tsunami is delayed.
And finally, that macroeconomic mirror you pointed out, the debt issue.
Yes, the bond market is flashing red.
We talked about the Fed's dilemma a moment ago.
Rising inflation keeps Western bond yields high.
The cost of servicing the U.S. $40 trillion debt becomes unsustainable if yields hit 4.8%.
And the source points out that while U.S. and U.K. yields are rising, China's are falling.
Global capital is fleeing the inflationary death spiral in the West.
For the first time in 20 years, China is being treated as the global safe haven.
So what does this all mean?
The fundamental takeaway from your excellent report is this. You cannot print physical atoms.
You can print currency to suppress financial panic.
You can manipulate paper markets to project stability.
But you cannot print the oil required to move freight or grow food.
When the physical reality becomes too big to hide, the illusion breaks.
And according to that April 20th timeline,
that moment is no longer weeks or months away.
It's here. Thank you so much for sharing your incredible research with us.
Yes, thank you for listening and for joining us on this deep dive.
We'll catch you next week.
See you next time.
Why she sounds so excited about that? We're talking about the deadline for the last tanker that left before the strait closed to show up and to start the idea of the supply shock. And she's like, it's here. Give me a second. Something's wrong with the mic. Hold on. You hear me now? Still doing it. Hold on. About how long has that been playing? Because it stopped early. Roughly. Hold on, I'll figure it out.
Physical infrastructure. We can't just flip a switch and use our own oil.
So when the public, and frankly many...
Is it still bad? You can still hear it? Yeah, I don't know what that is. Hold on.
Would never do.
Right, because that leaves the military with literally nothing in the event of a direct conventional war. But even if they did drain it to zero, it wouldn't even cover half of the total estimated global shortfall of 780 million barrels.
It's a drop in the bucket. It is. And if we look outward to global spare capacity, which is basically the amount of extra oil countries can pump if they open their physical taps all the way to maximum, the numbers offer absolutely no salvation.
How much spare capacity is out there?
Well, the U.S. can surge maybe 1 million extra barrels a day. Venezuela can manage maybe under 1 million. Canada can push perhaps another million through Pacific routes.
So if you add up every emergency pump, every alternative pipeline, and every single drop of spare capacity on the entire planet, you get maybe 2.8 million barrels a day.
At best, against a gaping daily deficit of 8 to 13 million barrels.
It's like losing a fifth of your body's total blood volume, and the paramedic tries to stabilize you by putting a Band-Aid on your forearm. The math of the emergency reserves simply does not match the math of the wound. We are bleeding out.
The medical analogy is really apt here because it highlights a critical distinction we have to make between different types of economic shock.
What do you mean?
Well, most people remember the oil market chaos of early 2020 during the COVID lockdowns.
Oh, yeah. When the price of oil actually went negative for a few days.
Right. Producers were literally paying buyers to take the physical oil off their hands because all the storage facilities are overflowing.
But that was a totally different mechanism. That was basic economics.
Exactly. That was a demand collapse. Commuters stayed home. Airlines...
It's weird. It's still doing it.
The harsh, unavoidable reality of their weekly budget.
And that budget is about to get absolutely decimated.
Yo, I cannot figure out what the hell happened. Yeah, no, but I didn't. I literally haven't changed anything. So I'm trying to figure out how something switched on its own. All the levels look like they're supposed, like where they're supposed to be. But hold on.